In the past 3 weeks, the stock market hasn't really moved all that much. The S&P 500 has seesawed back and forth and sits up about 1% over that time period. But there are a number of stocks that have gone through some turbulent times during this earnings season, and some stocks haven't even reported earnings yet, and they still find themselves down well off their 52-week highs. As such, in today's video, we're going to talk about 3 stocks to consider buying the dip on. All 3 of these companies have come well off their recent highs. So make sure you stay tuned throughout the entirety of today's video. And before we jump in, do me a huge favor. It just takes a couple seconds to simply tap that like button down below. Subscribe to the channel. It really helps, and I truly appreciate it. And let's jump into it. Hey everyone, Mark Roussin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And when it comes to investing and finding stocks at reasonable prices, Fiscal.ai has made life for investors so much easier, and I want to thank them for sponsoring today's video. Whether you want to find certain KPIs for stocks, like if you were researching Amazon, you could find the growth in just their AWS segment, which is both a growth driver for the company and a high margin business. Or if you were researching Spotify, you could find the number of subscribers that they have by year. Fiscal.ai helps take you as an investor to the next level. There is so much data and charts that they make so easy for you. Seeing trends of a business is so huge when analyzing a company. For example, you can check the free cash flow of a company like Broadcom by year and also look at their free cash flow margin at the same time. You have the ability to create any chart you want and compare companies as well to take your investing to the next level. And the best part of all is you can try all of it out completely free by using my link down in the description below. And when you see how powerful this tool is and you want to keep using it, you will get 15% off by using that same link off any paid subscription. Check out Fiscal.ai today. All right, let's jump back into our video, taking a look at 3 stocks to consider buying the dip on. Beginning with stock number 1, which is going to be Marvell Technology, stock ticker MRVL. And it might be kind of surprising to hear a chip name on a dip stock list. Because when you look at the SMH, the popular semiconductor ETF, you will see that it's up 20% year to date. However, when you look at Marvell, it hasn't participated in the 2025 chip rally. Taking a closer look at Marvell, we could see the company has a market cap of $67 billion, making it the smallest company on our list today. But year to date, shares are down over 30%. And over the past 12 months, they're actually up nearly 30%. Quite the difference between the 12-month performance and the year-to-date performance. The downturn for this company started in the first quarter when they reported their latest earnings results, which actually beat on both the top and bottom line. However, guidance wasn't so great, and that sent shares tumbling. And the next report that we're going to get is going to be at the end of August. So if you don't yet own a position in Marvell, maybe you nibble here, don't go in too much, wait for the updated numbers so we can get a fresh look at how the company is doing. And then if we get a dip, go in further. This is how we dollar cost average into building out a position. This is a company that is well positioned within the AI race and the expanding data center footprint. Marvell has great relationships and access to the hyperscalers, as you can see here. Spending from the hyperscalers is not slowing, but it's actually growing year by year. The company expects data center total addressable market to surpass $1 trillion by the year 2028. All of this bodes well for Marvell. From a financial perspective, the company continues to grow from various phases of the business. Revenues have reached a record $6.5 billion. EBITDA has reached $1.1 billion. Free cash flow is up to $1.4 billion, and the company is operating with a free cash flow margin in excess of 20%, which is something I love to see. From a valuation perspective, shares look fantastic as they trade at a forward PE multiple of just 26 times, well below the company's 5-year average of 30.5 times. And with that, EPS is expected to grow more than 50% over the next 12 months, giving this stock a PEG ratio well below 1, which is again very intriguing from a growth standpoint. Analysts rate the stock a buy with an average 12-month price target of roughly $90 per share, implying 17% upside from current levels. And that leads us to stock number 2, which is going to be CrowdStrike, stock ticker CRWD. And when it comes to CrowdStrike, they are the premier cybersecurity name. And there's a number of different cyber names that I like out there. But the leader is CrowdStrike. And when we get meaningful pullbacks in this name, it's a position I want to add to. And I believe the two main themes moving forward are going to continue to be cybersecurity and AI. And after all, AI just pushes the growth even further for cybersecurity down the road. When it comes to CrowdStrike, they currently have a market cap of $106 billion. On the year, shares are up 22%, and over the past 12 months, shares are up 77%. This is a stock that's actually been having a solid year in 2025 and over the past 12 months. However, shares are off roughly 20% from their recent 52-week high. And this is yet another company that hasn't yet reported their latest earnings report that will come again at the end of August. So keep that in the back of your mind. One key metric that I love to look at when it comes to CrowdStrike is annual reoccurring revenue. This is a subscription-based company. Right now, they have ARR of $4.4 billion to go along with strong free cash flow margins of 25%. Looking back at fiscal.ai, we can see the company's ARR by year, which is now sitting at a record high. And this is an important metric to track when investing in CrowdStrike, as it tells you sales that are coming in. They've made the sales. The company has to deliver now the service. Even as the company continues to reinvest, they continue to find ways to grow their free cash flow, which is also a very strong sign. Now, when it comes to CrowdStrike, they're still relatively a young company. They don't have a ton of years under their belt of earnings. So traditional valuation metrics, earnings metrics aren't things that we want to focus on all that much. So when it comes to CrowdStrike, we're going to look at them from a technical perspective. Looking here, we can see that the company has had a nice run from the April lows to the highs in early July. But since then, we are going to be using Fibonacci levels, and we can see the stock hovering around that 50% retracement level, meaning the stock has given back nearly 50% of those gains during that period. Usually a great spot for technical investors to look for an entry point, and that level is close to $400 per share. In addition, that $400 per share spot also, coincidentally, coincides with the 200-day moving average, which is typically a key line of defense for stocks. And a third angle we can look at in our favor is at the top of this, where you can see the RSI indicator, which is nearing a reading of close to 30, which gives us an indication of a stock being oversold and prime for a bounce. So 3 different angles, all looking great for investors around that $400 level. Of the 2 stocks that we've looked at so far and the final stock to come, all of them are already within my portfolio, and I'm looking to build my position in them. And if you're interested in seeing my entire portfolio and get alerts anytime I buy or sell a stock, then consider becoming a subscriber to the Stock Investor's Edge, which is my premium newsletter. You can check out the link down in the description below. And that's going to bring us to stock number 3, which is going to be Salesforce, stock ticker CRM. And yes, Salesforce is another position within my portfolio. And they are a software leader, and software stocks have been getting hit rather hard of late. I believe that over the course of the next 12 months, we're going to look back on this period in time right now saying, I wish I bought more Salesforce stock. Because with this company, they have subscription revenue, they have solid margins, and a great management team. And the stock's trading very cheap. Salesforce currently has a market cap of $222 billion, making it the largest on our list today. However, year-to-date, shares are down 30%. And over the past 12 months, shares are down 7%. So again, a stock that has been left in the dust and having a brutal 2025. But remember the age-old saying by the great Warren Buffett, we want to be greedy when others are fearful and fearful when others are greedy. And when it comes to Salesforce, there's plenty of fear to go around. A lot of that fear has to do with AI, and AI replacing some of what Salesforce does. And in all honesty, it's really investors not understanding the impacts of AI when it comes to a company like Salesforce. So for me, I let the facts prove to me and tell me the story of Salesforce. So for those fearful, check this out. Sales are sitting at record highs over the past 12 months at $38.6 billion. EBITDA sits at record levels of nearly $11 billion. And operating margins are at their highest levels ever, pushing 20%. Okay, well, all of that looked rather fantastic. So maybe it's the free cash flow. That's why we should probably be fearful, right? Let's take a check. As we can see here, the company is generating more operating cash flow than they ever have, which is the orange color on this fiscal.ai chart. When it comes to free cash flow, it's at the highest it has ever been, which is that purple line on the chart. And the green line happens to be the free cash flow margin, showing the company is generating more free cash flow from its sales than they ever have at 32.8%. Do not let analysts sway you based on their feelings. Let the facts guide you. So taking a look now at valuation, check this out. The company trades at a forward PE multiple of 19.9 times, well below the company's 5-year average of 35.3 times. Looking at a different angle, from an EV to EBITDA perspective, shares trade at 19.8 times, again, well below the 5-year average of 39.7 times. This is a stock trading as if the growth is completely gone, well below historical averages, yet the results are at all-time highs. This is how we find high-quality assets at great valuations. And when it comes to analysts, they rate the stock a strong buy, with an average 12-month price target of $350 per share, implying more than 50% upside from current levels. Heck, if I even got half of that, I would be pretty happy with this investment. So there we just looked at 3 completely different companies from different sectors: a chip company, a cybersecurity company, and a software company. All of these down meaningfully from their 52-week highs. And I'm thinking about buying all 3 of them on this dip. In the comment section below, let me know which of these 3 stocks do you believe is the best buy right now. And if there's another name on the list, or maybe not on this list, that you believe is a great buy, also let me know down in the comments. We're all looking to build wealth together. And if you haven't done so, make sure you smash that like button down below. If you found any value from these videos that we put out on a weekly basis, subscribe to the channel so you're notified anytime we drop new content, and we'll see you in the next one. Take care.